When most people look at the stock market, it can feel like chaos. Prices swing, news headlines dominate, and trends seem unpredictable. But behind the scenes, institutional investors like hedge funds, pension funds, and mutual funds are operating with precision that most retail investors don't see. These are the players moving billions of dollars, and their strategies often shape the very market you trade in. Understanding how smart money prepares for major market shifts can give you a huge advantage. Because when institutions adjust their positions, the ripple effects are enormous and often happen before the average investor even notices. The first step for institutions is analyzing the macroeconomic environment. They watch interest rates, inflation reports, unemployment numbers, and government policies closely. For example, when the Federal Reserve hints at raising interest rates, large investors don't wait for the official announcement. They model scenarios for sectors that will benefit or struggle. High-growth tech stocks may come under pressure, while financial institutions or consumer staples could see opportunities. By anticipating these shifts, institutions can reposition their portfolios to reduce risk and capture potential gains before retail investors react. Equally important is market sentiment analysis. Institutions track how investors feel about the market, sometimes even measuring fear and greed with specialized tools. They look at trading volumes, options activity, and social sentiment to detect early signs of panic or euphoria. This allows them to act ahead of widespread public reaction. For example, if retail investors are overly optimistic about a sector, institutions may slowly start selling into the enthusiasm, while they buy when fear drives prices too low. This contrarian approach is a key reason institutional investors often outperform the market. Risk management is another cornerstone of institutional strategy. Large investors cannot afford to gamble recklessly, so they diversify across asset classes, hedge positions, and maintain liquidity to navigate volatile markets. Hedge funds, for instance, use derivatives to protect against sudden market drops, while pension funds balance long-term growth with safer assets like bonds and cash reserves. These strategies may seem invisible to the public, but they are essential for weathering uncertainty and ensuring that even a major market shift doesn't derail their portfolios. Institutions also focus on positioning ahead of trends rather than simply reacting. They study historical market cycles, company earnings reports, sector rotations, and technical patterns to identify which markets are likely to rise or fall. For example, during the 2020 tech rally, institutional investors had already increased exposure to cloud computing and software companies before most retail investors recognized the trend. This proactive approach is what allows smart money to capitalize on shifts in the market, while others are still waiting for confirmation. Liquidity management is another subtle but critical factor. Institutions don't make large trades all at once because doing so could drastically affect the market price. Instead, they execute trades in stages, sometimes over several days or even weeks, to avoid moving the market against themselves. This careful timing ensures that their strategy remains stealthy and effective, while retail investors often only notice the market movement after the fact. Access to information and research gives institutions an edge that most retail investors simply don't have. They leverage proprietary data, analyst networks, global research, and early insights on mergers, supply chain disruptions, or regulatory changes. Acting on this intelligence early allows them to anticipate market shifts, positioning themselves for growth or protecting capital before trends become widely apparent. Even small insights, when applied to billions of dollars, can have a significant market impact. Behavioral strategies also guide how smart money moves. Institutions are aware that retail investors often follow the herd. They exploit this by taking contrarian positions, buying when fear dominates and selling when optimism is at extremes. This is why sudden market reversals often appear unexpected to the public. In reality, these reversals are the result of carefully orchestrated moves by investors with deep insight, patience, and the capital to act strategically. Technology has transformed institutional investing. High-frequency trading, algorithmic models, and AI-driven predictive tools allow institutions to process millions of data points in real time. These tools enable them to spot trends and react faster than humans could, giving them a significant timing advantage. While retail investors may rely on headlines or daily news, institutions are acting on predictive models that anticipate market moves before they occur. Executing. Executing trades in milliseconds when opportunities arise. For retail investors, the lesson isn't to copy institutional moves blindly, but to learn from their methods. Observing macro trends, maintaining diversification, monitoring market sentiment, and exercising patience can put you ahead of the curve. Understanding when to act and when to hold can make a significant difference, especially during periods of market volatility or major economic change. In conclusion, what may appear as randomness or chaos in the market is actually a highly orchestrated system driven by smart money. Institutions prepare carefully, manage risk, and anticipate changes with precision using data, technology, and behavioral insights. By studying their strategies, you can gain perspective on how markets really operate and make your own investment decisions with more confidence. Smart money isn't about luck. It's about preparation, timing, and insight. And by applying even a fraction of these principles, retail investors can better navigate market shifts, staying informed and positioned for long-term success.